It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks recover the losses from last week's rout led by Japan as the yen weakens. Markets finding their footing ahead of the key US inflation print. Haven plays and focus on rising geopolitical risks. Brent crude holding above $80 a barrel. Israel bracing for a potential strike from Iran. Plus, India's booming economy and credit markets are creating an unwanted side effect, one of the world's worst attrition rates for bankers. Let's check in on how markets are doing, though. Avril Hong's in Singapore. Avril.
Yeah, Paul, we're seeing Asia stocks rising for yet another session, 0.8% higher on the MSCI Asia Pacific, and it's pretty much trading at levels before we saw that stock market rout of last Monday. And this is led by the gains we're seeing in Japan, back from a holiday, but also in a way playing catch up, given how we're seeing the Kospi, the TAIEX in negative territory despite clocking gains a day ago. It really gives you the sense of how important the upcoming US inflation print is going to be and how perhaps the tech sector is going to be vulnerable if we see data that supports this hard landing scenario. Japanese equities catching a bit of a bid, also helped along by what we're seeing in the yen potentially. As you say, there are some safe haven bids. Certainly we're seeing some gains on the US 10-year treasuries. It's also playing out these concerns about geopolitics on oil prices, which surged $3 a barrel on Brent crude and WTI just a day ago. Flip the board, let's take a look at another corner of the market, CGBs, that the PBOC has been really taking pains to try and cool. And we've seen it, taking a bit more extreme steps, telling China's rural banks as part of Jiangxi province not to settle their recent bond purchases. So essentially telling them to renege on their market obligations, and that seemed to have an effect on markets. Just a day ago, we saw that steep selling, a bit of a reversal on the 10-year in China today. Paul.
All right, Avril, stick around for more on the latest moves. Let's bring in Jason Pang, Asia FX and Rates Portfolio Manager at JP Morgan Asset Management. And Jason, it's been a very weird week, almost like a fever dream. We're kind of back to where we were last Monday, but a lot of those risks are still there, still in place, still present. Do you think there's a risk we could see that sort of volatility and those wild swings return?
Sure, Paul. Well, it has been a very wild week overall. So we've gone from soft landing, hard landing, the emergency landing, and right back. So I think it is a very tricky environment at this juncture. Having said that, we are seeing some degree of normalization. You see that in the yen carry trade being rebuilt at the margin. You see that in VIX and VVIX and the MOVE index. There's a degree of normalization across the board from a cross-asset volatility perspective. So I think this week then, given when you look at where the U.S. Treasuries are priced, we are priced for 50 bips in the upcoming FOMC. We're almost priced for 200 basis points on 1 year already. So I think within that, the market is already priced to some degree on the hard landing or the fears of that. All eyes will then be on CPI and retail sales this week to see how it plays out. But I think that's where we will be. So we'll be in a holding pattern for the time being for this week, I suspect.
Jason, among some of the safe havens, is there a preferred one, a safe haven of choice? I mean, you flagged some of the risks surrounding treasuries, surrounding the yen already. Does this support the dollar?
So I think overall, we are caught in a very difficult conjecture. As you probably can guess, there's a lot of money that has been lost from the carry trade implosion over the past week. As such, then, it's not entirely clear to me that there is sort of a good positioning per se from a haven perspective. But let's say that if you do get a much worse number on CPI, for example, it is quite reasonable to expect the yen to rally, so that would remain one of the flight to qualities. But when you look around Asia FX, there are some sweet spots that we think are quite attractive. So when you look at, for example, the Singaporean dollar, the Malaysia ringgit, the Thai baht, all of these currencies actually behave very similarly to some degree during the DXY liquidation phase. And like the yen, they actually rallied a rather sizable amount. So I think what it tells you is a few things. It tells you, first of all, that there is a funder to be or carry trade being built within these currencies in the system. And number two, then people definitely don't have the position. So if you look at exporter repatriation, the dollars that have been hoarded over the past 3 to 5 years in this higher for longer U.S. Treasury markets, I think that is now coming into play and fruition. As such, then, if you do see a haven bid, I think that probably those Asian and ASEAN currencies will also benefit as well.
Well, we've seen an end, or have we, to the China bond rally. Yields have moved quite a lot in the past few days. Do you think that that is now behind us as well, or can you see that rally picking up again?
So I'd probably say that overall, China is a rather idiosyncratic market, Paul. What I mean by this is if you think about the overall capital account, it is a closed capital account. So I think when you think about from the fixed income, we have had warning shots over the past few weeks on the CGB yields not being too low per se, or you should refrain from buying much lower. And I think we are starting to see the efficacy of that play through into the markets via the recent deleveraging that you see. Within the onshore investment system, typically, the investment funds and some investors are built upon about a 30 to 50% leverage ratio. So I think when you look at what's happened, we've seen the deleveraging over the past few trading sessions within the CGB market, not only in the long end, but also in the short end of the CGBs as well. Having said that, if you look at the equity market, it's actually been flat. So what it tells you is that the system is more under a deleveraging type of phase rather than a reallocation of capital. So the question to me then becomes, if there's value creation in the CGB long end, and you are moving to fourth quarter elections where there can be more headlines from a U.S. election perspective, at least to me, even though it may not be today, we still do believe that the CGB duration side of the trade serves as a good geopolitical or headline hedge. And hence, I don't think we have a change in view on the CGBs. The FX, again, remains optional. So I think when you look at the CGB 30-year, if you hedge it into U.S. dollar using the CNH FX forwards, you can actually extract a yield that's actually quite competitive and even higher versus 30-year Treasury. So we do believe that net of those parameters, at least for us, we haven't changed our minds on the CGB long and duration trade.
Jason, what's your takeaway from what the PBOC is trying to do in totality, given how it's been guiding the Chinese renminbi weaker, but we also see how it's trying to set off this interest rate reform, it seems?
Sure, April. So I think the overall FX biases indeed have been fixing weaker gradually. So we have seen about maybe 7 to 20 pips weaker every day. And it's quite systematic. I think then commensurately to that, and that's related to the interest rate reforms, I think that basically they are trying to adjust or balance between the interest rate differential, which even though we've seen some relief versus the US recently, we have to remember that from an actual policy rate perspective, the Fed actually has not cut, right? In the meantime, then you did cut basically the 7-day repo rate amongst many other rates in the onshore market. So if you had to account for the interest rate differential, I think naturally a slightly weaker CNY fixing is a very natural consequence of that, if you ask me. It also helps balance or serve as a balancer towards the overall economic cycle. And finally, then, if you look at it, the yen has also been weakening as well. So I think if you had to sort of enter a carry trade or funder trade, which, as you know, the renminbi is one of those amongst many others, such as the ones that we outlined before, then I do think that those are some of the reasons why you can see that there's been interest rate reform. There is at the margin an easing cycle bias built into the system. And because of that naturally lowering of interest rate differentials, that should over time still reflect into a slightly weaker currency. But if you look at spot FX, we actually haven't traded at the highs. So I think, again, we haven't actually seen the dollar CNH or dollar CNY break materially above the 730 mark so far.
Okay, so yuan for carry. What about the Philippine peso for carry opportunities? It's part of your contrarian calls.
Yeah, so I think we are turning a bit more constructive on Asian currencies as a whole. And I think Philippine peso is one that probably investors own a bit less per se. And you can see this in both the equity and also the bond holdings from a 400 percentage holding prospect. Now, why the Philippine peso? And I guess, why in particular this currency? I think it's because, first of all, it's under-owned, like what we described. But secondly, if you think about what's basically happened over the past week, people basically have lost on sort of the short yen versus long LATAM or other carry trades within the rest of the region. So if you sort of had to rebase it and say, well, I'm seeing normalization, but I'm not ready to really do a very big carry trade of over 10%, annualized yield, then I think then what you want to do is you want to maybe short the yen or short some other Asia FX, and you want to long something within the region. Well, there's three currencies you're going to long, right? You're going to long Indonesia and India, both which offer high degrees of carry. But you probably own them already. So what's the residual? The residual will be the Philippine peso. Again, if you look at actually seasonals, usually the fourth quarter, you can also benefit from foreign remittance. So taking all those into account, you don't have to pay anything. You get a bit of carry. If you want to short the yen, you can short that and you get paid a bit more. It's not a heavily owned position on the currency side as well. So those are the parameters which we do like and justify this more contrarian type of trade.
Jason, tell us a little bit about your calls for ASEAN local currency bonds as well. What's your thinking there?
So if you look at the extent of how much the U.S. Treasury side of things have priced, right, and we've talked about that a bit before, I think if you look at the Asian curves, aside from some select ones, most of the ASEAN curves are actually quite benign. So take Malaysia, for example, there's not many expectations of any rate cut at all at this juncture. And that takes into account some of the fuel subsidy removals and all that. Likewise for Thailand, there's some expectations of easing, but not a lot. Indonesia, maybe a bit more. But when you look at those price-ins relative to what's happening with the U.S., if the Fed does cut 50 bips, I think that can actually cause a rather attractive change on the one-year or the easing pricing within the ASEAN markets, where we see a more accelerated one. So, if you look at the inflation across the region, there's never been any issues per se. In the case of Thailand, Malaysia, Indonesia, headline CPI has been very manageable. So if you take that into account in the real rates, there is room for easing. So I think because of all this, we have been advocating and are more constructive this year on an overall Asian local duration across the Malaysia, Thailand, and Indonesia. Finally, I think just to mention on Malaysia and Thailand, if you buy the long end of the curves, you hedge it into US dollar, again, you can extract something that's maybe high fives or even 6% or higher in terms of synthetic yield, which again is actually much more competitive versus many US dollar 30-year credits or 20-year credits and even the US Treasury 30-year itself.
Speaking of room for easing, we had an encouraging read for CPI out of India. What's your expectation around the RBI's next move and when it happens?
So headline CPI came in maybe closer to 3.5, which is indeed below the 4% target. You look at basically the last RBI stance, it was not unanimous, right? So I think there is sort of a gradual bias that they want to ease, albeit I think it's still taking time in terms of decision. Again, I think if you look at almost all Asian policymakers, everyone is indeed waiting for the FOMC to start easing before they start engaging in their own easing cycles. And likewise, you can see that there's been some degree of Middle East tensions that's naturally going to leave a lingering left tail on oil prices. So as a policymaker, it's not clear to me that you want to move too quickly given all of these major events. If anything, then I would suggest that maybe it's worthwhile to wait a bit more before they actually ease. So I think that is the expectation there. But having said that, our IGBs, Indian government bonds, an attractive investment destination, we still believe it is.
What about the risk for the rupee amid the global macro backdrop? I mean, what sort of headwinds do you see there?
So I think the Indian rupee has been one of the more lower volatility currencies within the recent sell-off, even though we have seen a sell-off at the margin to sort of close to the 84 context, we've actually seen support on the top side as well. So I think the way that we've been looking at it really is, is it one of the carry trades? Yes. Does the FX have volatility? Yes. But is it dramatically higher vol versus some of the other Asian currencies? It's not very clear to us. So again, right, I mean, if you believe that, as I said, the funder or the carry trade is back and you want something that's more carry, but you don't necessarily want to go into the deep end with the highest volatilities of the world, like the Mex peso or other currencies, then I think Asia serves as a sweet spot, and Indian rupee is definitely within those sweet spots. Especially if you look at the volatility parameters compared to some of the other carry currencies. It's not that high. So I think in that context, it's not clear to me that it's a very weak type of currency per se. Finally, then, again, don't forget that RBI has been accumulating foreign reserves over the past few cycles, and they've basically avoided from a substantial appreciation on the Indian rupee. As such, on the flip side, it's not clear to me that they would actually want a much weaker or depreciating type of currency either. So I think it's more of a steady state carry, if you ask me, within the region.
All right, Jason Pang of JP Morgan Asset Management. Please do stick around. We'll cover some more ground coming up. And also ahead, our exclusive interview with cybersecurity firm Checkpoint. We discuss their investment in India and the growing risk of cyber attacks. That's coming up. This is Bloomberg. Welcome back. Here's some live pictures of northern Israel. Of course, this is reasonably near to the border with Lebanon, where Hezbollah is active. Of course, Hezbollah, one of the was sponsored by Iran, and US officials say an Iranian attack against Israel has grown even more probable, may come as soon as this week. They say Israel believes a strike by Iran or its proxies is increasingly likely, and Washington shares those concerns. The US has been shoring up naval and air forces in the Middle East to help Israel fend off any major attack ahead of a resumption of Gaza ceasefire talks, which are planned for later on this week. Now, in that context, we have seen the oil price rallying pretty hard. It's backed off a little bit today. WTI did break through $80 a barrel briefly. We're just hovering below that now at $79.33. But here you see that the oil trades, we've got WTI testing that 100-day moving average against the backdrop of that tension in the Middle East. So let's get the latest on the impact on oil markets now. Bring in Bloomberg oil trading reporter Yong Chang Chin. Yong Chang, if we take a look at this rally in oil prices, I mean, to a degree, we have seen this movie before, but is it this time different? What's the path of least resistance for oil from here?
Yeah, hi. So for oil, obviously one of the big drivers in recent sessions has been the tensions in the Middle East. I think what's interesting is that because it's not like this sudden ratcheting up in tensions is new. We've had Hezbollah and Hamas and all these actions have been going on for quite a while. But I think oil's only really reacted once Iran has entered into the picture, and Iran, as you were saying, the Iranian response to the killing of the Hamas leader in Tehran is looking increasingly likely, and that's because Iran is, how do we say, it's kind of, it produces a lot of oil, so markets only really react once there is the threat of supply, and that's kind of why we have been seeing such a strong reaction in response to Iran specifically saying that they will target Israel, because once Iran gets in the picture, might there be increased US sanctions, might there be a further hit on Iranian oil exports or further attacks in the Red Sea. Those kinds of things are what investors are worrying about, and that kind of partially explains the rally that we've seen in prices recently.
Given how we've pulled away from the peaks on Brent crude in April, though, it really makes you wonder of the other side of the equation, demand. We have OPEC now cutting its demand forecast for this year and the next. What does this tell us about the extension of production cuts and the demand-supply balance?
So I think on that front, there's sort of two things that we can say. The first thing is that oil kind of, it's a financial asset. It was very much, as we were talking about earlier in the show, very much kind of caught as part of the unwinding of the yen carry trade. When equities were selling off hard, oil was one of the risk assets that investors were also pulling out funds off. So that's kind of generated downwards pressure. We see from the latest positioning data that oil investors are, I think, the most bearish, least bullish, I should say, that they've been on Brent crude since data going back to 2011. So there is that very much a sense of risk off in markets, but also on the physical market side, there appears to be signs of weaknesses. We have refineries in the US running slower on expectations that there's just simply less demand for products like diesel and gasoline. In China as well, the picture is soft with also just less demand. So, overall, just kind of a bearish picture, which kind of putting downwards pressures on prices.
All right, Bloomberg oil trading reporter Yong Chang Chin there. Well, Jason Pang is still with us, Asia FX and Rates Portfolio Manager at JP Morgan Asset Management. And Jason, as we left off, you did make a mention of the geopolitical tension that we're seeing at the moment. How closely are you factoring that into your strategy? Are you making any changes with that in mind?
So I think the good news, like what we discussed in the previous segment, was that a starting point for headline inflation across the board is generally low within the region. As such, then, even if there was a 10% oil price shock, I think overall the markets here will be able to withstand that. At the top side, in some of the more heavy oil-heavy type of importers within the region, I think at most that would translate into maybe top side 1.2% of headline CPI push under a 10% increase assumption. As such, then, even if I factor those in, I don't think it changes anything what we've discussed. However, having said that, if you think about it from a monetary policy perspective, that's all the more reason why I think the central banks within the region do want to watch and see what the Fed does first. And following that, I guess by then you'll probably get a bit more visibility with the overall geopolitical tensions in the Middle East. And if that's the case, then I think that, again, still opens the leeway or sort of headroom, per se, to actually ease further within the Asia region.
Jason, and as we look to what we're getting out of Asia central banks, of course, the big elephant in the room is the kind of cuts we're going to get from the Federal Reserve going forward. Do you think we are underappreciating the inflation risk, though, especially given how oil prices seem to be coming back? I know that seems to be increasingly like a secondary concern, but there seems to be this mismatch between what swaps and what bond markets are pricing in.
I think in the macro markets right now, and I'm sure that we've heard about this as well, some people have been talking about stagflation or other concerns. I think the macro scenarios outcomes right now are actually quite broad. Not only do you have the yen carry trade fear per se, and that warrants that 50 bips easing or 200 bips easing on the U.S. curve, but on the flip side, as what you mentioned, Averill, there is a geopolitical tension risk within the oil side. But again, if you had to sort of choose, then it boils down to, are you more scared of the oil price increase or the risk off? I think at this juncture, from what we can see in asset reactions, there's definitely much higher concern on the overall flight to quality or haven bid. As such, then, even though near term we might need to acknowledge that there can be an oil shock per se under further escalation, it's not entirely clear to me that investors can actually afford to also miss the upcoming rate cuts or sort of the flight to quality biases that we're seeing within the duration side on U.S. Treasury. So I think taking that into account, what's the trade? How do you translate that? Well, if you're afraid or concerned about the oil price shock, then maybe you should actually buy a bit more tips as well to diversify the book, right? So look into 10-year tips, 30-year tips versus 10-year, 30-year conventionals. Just buy a bit of both, and I think that can serve as more balancer within your portfolios just to hedge that risk.
All right, Jason Pang of JP Morgan Asset Management, thanks so much for joining us. We do have plenty more to come. This is Bloomberg. Well, here's something we were waiting for. It's kind of interesting as well. We've got changes to the MSCI Emerging Markets Index. We saw 60 China deletions from that EM index, 7 additions from China. We'll have to see the weightings before we can say if India overtakes China in that EM index. There you see some of those names in the index and how they're performing well. We're taking a look at some of the earnings out of Asia as well. Krafton shares jumping 11%, big profit there, and a dividend increase as well. And the athletic wear maker Yuyun Industrial Holdings also seeing some gains at the moment. Plenty more ahead. This is Bloomberg.
In terms of the lack of things to buy for people with the funds, lack of certain returns for the likes of the insurance companies, etc. That means those are trying to stem that flow is a little bit like swimming upstream. A lot of money waiting on the sidelines, and a government bond with their yields as the way they are seems pretty attractive. Not just for investors, but for banks, insurance companies.
It's definitely need to, set the floor. I think, government doesn't really want the bond yield to be sort of like, at very low level. It's, it's also reflecting some sort of recession. We think there's no recession. At the moment, it's more growth scare, like, slowdown, concern about slowdown growth. And therefore, we reckon that, like, in terms of Treasury, at this point of time, there could be some room for it, for the yield to go a little bit higher.
Here's some Bloomberg TV guests earlier discussing China's bond rally. Welcome back. We have China markets just heading to lunch at the moment. In fact, Bit of a risk-on day around much of the region, not so much in China though. We've got the CSI 300 off just a few points at the moment, weaker by about 1/5%. The Shanghai Composite looking kind of flat right now. And we've been running a story on Bloomberg today about foreign investors pulling a record amount of money from China last quarter. If this continues for the rest of the year, we might end up seeing the first annual net outflow since at least 1990. That's when data began. All right, let's take a look at how markets elsewhere are doing. Avril's keeping an eye on things. Avril.
Yeah, we're going across to another EM poll, taking a look at India as we got that inflation print yesterday that in the first time after almost 5 years came in below the RBI's target. But of course, this easing in the inflation print was something that the RBI had already flagged. It said it would come down because of these statistical effects, and it expects it to pick up as we approach the end of the year, as those base effects wear off. For the time being, though, it looks like the India bonds are catching a bit of a bid. We're even seeing a bit of a recovery in the rupee towards the 83.95 handle. Let's take you to Japan, where markets are also back from the lunch break. And of course, today, equities there have been leading the gains as they're back from a holiday and they're trading at levels that we haven't seen since the stock market rout of last Monday, perhaps supported as well by what we're getting on the Japanese currency, hovering at 147.3 level. Today, we also got producer inflation showing that pickup. Lots to unpack. Let's bring in Bloomberg MLife strategist Mark Cranfield. So we're seeing, just based on the data, of course, the big one out of Japan is going to be the Q2 GDP print. To what extent do you think it's important for it to support the hawkish stance for the BOJ? Because regardless, it does seem like Ueda is keen, determined to dismantle unconventional monetary policy.
Yeah, I don't think he's going to be dissuaded from that, but obviously we need a bit of a healing period. We had such chaos in Japanese financial markets, and of course a lot of criticism was directed at the timing of the Bank of Japan move. So everybody's a bit skittish at the moment. In fact, there's going to be a parliamentary inquiry in Japan starting this week as well to discuss was there something wrong with that timing of that decision. So Mr. Ueda is very much going to be in the spotlight. But there are 3 more central bank meetings before the end of the year. I don't think realistically anybody expected that they would change rates in September anyway. So I think we're getting ahead of ourselves to say that just because they raised rates in the last meeting that they would do it again at the next meeting. That's not been their style anyway. So it was always much more likely that it would be towards the fourth quarter, providing that the data continues to support the story. Now, they still need that. They've had the wages increases have happened, and they're pretty sticky. We're about to get the civil service in Japan is about to get the largest increase for like 3 decades, something like that. So clearly that is happening as the BOJ wanted, but they probably would like to see a little bit more evidence in the CPI as well in Japan, which has been there, but they probably need to see it continue. In the meantime, they're fending off criticism from all areas. Mr. Ueda needs to get through that period. We need to see some stability. Once that's out of the way, people will probably reflect on the fact that 0.25 is still way too low for Japanese yields, and they do need to go a bit higher.
Then what does that mean in terms of the monetary policy? Will it be seen as normalization or tightening then? Because it has come back and tried to, push back against the sense that it's tightening.
The way that traders are pricing it, it's not even normalization really. And we would probably need to see 10-year Japanese yields even closer to 2% before people even thought it was something like a normalization period. If you look over the long history of where Japanese yields have been, and we're only not even at 1% at the moment. So we're way, way, way off from anything that in a historical context would suggest that Japan is near a neutral rate or something, anything close to normal. However, things have changed a lot over the time. Yen's in a different place as well. It's not as strong as it used to be. We're no longer at 100 yen to dollar, although some people do expect that to happen in this cycle. So everything has to be adjusted. Something like even 1.5% for 10-year JGB bills will probably be considered to be pretty high. And we may reach that sometime next year if the Bank of Japan continues on its path and everything falls nicely into place. But there are a lot of ifs, as you can see, in this whole equation. I think the one thing that investors can be reasonably confident of is that Bank of Japan is not going to backtrack, even though you might have external voices saying they've overdone it. As far as Mr. Ueda's concerned, if you look at his stockpile of JGB, it's enormous. They still own half the market in Japanese. That is not something that on a long-term basis is sustainable. He's talked about it. He wants to get it down. As part of that process, yields need to go up.
What about CGBs? We've been seeing the PBOC taking pains to cool that rally, recently taking more extreme measures, but that's going to have side effects. What do foreign investors make of all this?
The big issue is transparency. If you look at some of the things that have happened in the past couple of weeks, every little thing is a little dent at making the market a bit less transparent. International investors don't like that. If you're a big major portfolio manager, multi-asset, you can go anywhere around the world. You can go to the United States, you can go to Europe, you can go to any part of Asia. China is just one market you could allocate your money to, and they will be looking at it on a comparative basis. Is the information that I'm getting there, is it clear compared to what I can see in the US market or the European market? And because of some of the recent events, it is not as clear to an international investor. That means, okay, that's a bit tough for me, too hard for me to make a decision, I'll send my money elsewhere. So yes, you can understand why the Chinese authorities are doing it. They don't want a repeat of the savings and loan disaster that happened in America, where some of the banks were very exposed to long-term yields. Yields went up, it cost a lot of money. It was beginning to see signs of that in China. Of course, that's scary. But by being too tough about it, they're also at risk of putting off foreign investors, who they need. It's a very, very big bond market. They need to attract foreign flows, and they're making it a bit more difficult for themselves. So that is something that could backfire. And even though they may get what they want in terms of high yields, they also may lose participation from foreigners.
Can you help me understand? Because if it's going about this to curb what we're seeing in the bond market, on the longer end of things, the extent that it's going to be able to see where it wants yields to be?
Well, the yield curve, they always prefer it to be steeper. Most central banks do. They like the idea that short-term yields are down here, long-term yields are up here. That's a normal shaped curve. The longer you borrow money for, the more it costs you. That is a normal situation, which in some parts of the world isn't happening. Of course, the US curve has been inverted for a very long time. It's still slightly inverted even now. That doesn't help companies pricing their debt, doesn't help individuals looking for mortgages and things like that. So a positive shaped curve is much better. China's was getting a bit flat. China authorities would like to see a proper curve where the very long end, 10 to 30-year sector, is much higher than the short end of the. That's a situation that they can then build other structures around that. They can build a proper corporate debt market, they can build a retail market. If you have a market that's the yields are too flat, it's much more difficult to do it, and it brings the additional risks is that when there is a shock, if ever a time comes when China needs to raise interest rates, it will be much more volatile in the long end of the market and cause a lot more damage than it would in the short end.
Between the rock and a hard place. Mark, thank you so much. Always fantastic getting analysis from you. MLive strategist Mark Cranfield. Back to you, Paul.
All right, coming up, cybersecurity firm Checkpoint says cyber attacks are on the rise worldwide, especially in India. Their president joins us exclusively next. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You are watching the India Focus, and here's a look at Indian markets just ahead of the open. Looks like it's going to be a mixed to slightly soft day when we get going. The Sensex off by about 0.1%, so 4.5 minutes away from the open there. Well, the cybersecurity market in India is rapidly evolving, driven by the increasing sophistication of threats. Latest research from Checkpoint Software Technologies says India recorded the second highest number of weekly attacks in the Asia-Pacific last quarter. So for more on this, let's get to Checkpoint President Rupal Hollenbach. Rupal, thank you so much for joining us. Can you give us a bit of a sense, for context, the rate and the severity of cyber attacks in India?
Certainly. Well, thank you for having me. It's such an important topic. All around the world, cyber attacks are on the rise, and that's certainly true in Asia Pacific. But India in particular is presenting some alarming numbers. In fact, over the last 6 months, our research team has seen that the average organization in India is attacked over 3,000 times. Now, to put that into perspective and to give you some context, that is about double what we see from the global average. And 3 times what we see here in the United States. So it's an alarming and it's a growing number in India.
Why this severity, Rupal? What is preventing perhaps more prioritizing of the spending on cybersecurity infrastructure?
Well, I think that organizations all around the world are starting to really understand the magnitude of the business impact of these cyber attacks. And that's also true in India. In fact, we expect cybersecurity spending this year to reach as high as $3 billion. That's this year alone. That's across products, software, hardware, and services. And the opportunity for us is really to keep organizations secure by taking a much more consultative and a highly preventative approach to cybersecurity. I think it's getting on the radars of more and more companies, certainly public companies with scrutiny from regulators and from boards. And so I think that attention here is also on the rise. And it's one of the reasons we're very excited to have expanded our operations in India this year.
Certainly a lot of growth opportunities, Rupal, but just want to get your sense of, do we know where the majority of these attacks are actually coming from?
We certainly do. In fact, the top 3 industries impacted in India are no different than those impacted in our top markets around the world. And those industries are healthcare, education and research, and government and the military. Those are the 3 that are attacked the most. And again, as I said, the average organization is attacked over 3,000 times a week. So this really has a multiplicative effect. Now, I'm also happy to say, however, that at Checkpoint, we are securing some of the largest organizations in each one of these 3 verticals in India, and will continue to do so. Our investment in India continues to grow. I think the industry continues to grow in India, and organizations across the market are really starting to understand not just the technical implications to their organizations, but the real business impact to the organizations.
Are you able to say where those attacks are coming from? Are there countries in particular from outside of India, or is it domestic? And what are they looking for? Is it ransomware in nature, or is it something else?
Well, we certainly see 2 different kinds of attacks. We see those attacks that tend to focus on financial gain. Those tend to be individuals, groups who are really after some kind of financial gain. But there's a whole other part of cyber attacks, and that is really that which is geopolitical in nature, that which is nation states attacking other nation states, trying to find broad citizen data and gain access to that broad citizen data. And that's why, as you can imagine, government, military, education, research, healthcare, these are all industries that the most attacked also represent the largest repositories of broad citizen data. So we see both kinds of attacks. We see those who are, ransomware going after your money, but then also, and going after financial gain, but also nation states attacking other nation states. And in terms of the attacks that we see in India, they are both domestic attacks that happen inside, largely for financial gain, as well as those that are coming from outside of India, attacking industries inside the country.
Generally speaking, how enthusiastic do you find India's organisations are about beefing up their cybersecurity? And if not, what are the major roadblocks? Is it cost, or is it something else?
Well, I think, first of all, cybersecurity is not easy. The cybersecurity landscape has grown so quickly. The bad actors have grown so quickly. And so it's really hard to keep up. This is a complex world. It's one of the reasons why at Checkpoint we offer an entire platform of solutions, because if you protect your front door, that doesn't mean that the bad actor isn't going to get into your house. They're going to try the side door, the back door, from underneath your house, from above. And so organizations are being attacked from so many different threat vectors today. So why is it hard? Well, it's hard because the threat landscape is ever increasing. Number 2, the solutions that address them are largely point solutions that address a very specific part of your entire firm. But really, you want to protect the whole thing. And so more and more collaborative and highly comprehensive solutions in the form of platforms is what's going to keep you secure. But third, I think that people don't know where to begin. And that's why companies like ours are investing so much in markets like India to put people on the ground, sales, marketing, technical support, customer success. These are all functions that are not just about selling a product to a customer, but really helping to ensure their positive business outcome. In the end, that's what we're about. And when we protect organizations, we protect the people that are in those organizations. We protect their personal data, their professional data, and we protect those organizations. Now, I think industries are absolutely taking notice, and they're absolutely doing more to embed security into the design of their processes. And that's really good to see. Just to name a few of the organizations that we work with in India that we're really proud of. The first is actually in healthcare and life sciences, and that's Alchem Labs. Alchem Labs is a multi-billion-dollar company.
RuPaul, I take your point, really encouraging signs we're seeing in terms of some of the companies that you're working with. But just bringing the conversation back to what you mentioned about how the threat landscape is ever evolving, how are the solutions evolving alongside this? And how are you perhaps using more artificial intelligence as part of the mix?
Yeah, it's a great question. So our Infinity platform, and specifically the things that we are doing, is actually bringing AI. We're not just throwing AI into the mix in sort of AI washing, to use that term, but rather we're embedding AI tools, including generative AI tools, into the fabric of our products, into the very way that we develop them, and to bring people tools so that they can use generative AI in keeping their organizations more secure. We have several of those products embedded into what we call the Infinity platform, and we continue to add AI into every new product we develop, whether it's protecting your cloud, protecting your workspace, or protecting your network. We use AI across the board, and actually, we've been using AI for over 12 years.
All right, Ripal Hallenbeck of Checkpoint Software Technologies, thanks so much for joining us today. Let's take a look at how Indian markets are tracking, which did open while we were having that conversation. And in particular, of course, we're focusing on Adani stocks. We saw that group of companies take a bit of a hiding on Monday. Not so bad today, just off by a few points. Well, we've got the Sensex just off by a few points. Adani stocks, meanwhile, are doing a little bit better, recovering somewhat after the sell-off. We do, of course, have a situation where Hindenburg, the short seller, is now accusing the SEBI chief, the regulator chief, of a conflict of interest. SEBI is strenuously denying that. Adani itself also calling those allegations baseless. And we're seeing a little bit of a rebound in that Adani group of companies today. Plenty more to come. This is Bloomberg. India's banks are expanding into new geographies and businesses, driven by a nationwide credit boom and a strong period of economic growth. But the pressure to deliver has yielded a worrying side effect, one of the world's worst attrition rates for bankers. So for more, let's bring in our South Asia economy editor, Rishi Bhatia. Rishi, thanks for joining us. I just wonder if you can describe some of the pressures and talk a little bit about that attrition rate that Indian bankers are facing. Rishi, can you hear me okay? Can you describe some of the pressures and the attrition rates that India's bankers are facing? All right, we seem to be having some difficulty contacting economy editor Rishi Bhatia there. We'll try to get back to that if we can, but here are some of the top corporate stories that we're following. Bloomberg has learned Johnson & Johnson cleared a key hurdle in its $6.5 billion plan to resolve thousands of lawsuits by people saying that its baby powder gave them cancer. Sources say more than 75% of the group signed off on the company's settlement offer through secret balloting. The result would help J&J's efforts to contain liability to a unit that it set up to resolve the lawsuits. The litigation is ongoing. A Bloomberg analysis of government data shows US retailers, including Walmart and Target, are selling generic versions of the cold medicine Mucinex that contain a cancer-causing chemical, benzene. The chemical is unlisted, found inside a cheaper version of an inactive ingredient in the store brand option. US regulators have ordered the ingredient be phased out, but the deadline has been pushed to 2026 after industry complaints. All right, let's get back to South Asia economy editor Ruchi Bhatia. Ruchi, we were talking about some of the pressures, the attrition rate that's being faced in India's banking industry. Can you give us a sense of the problem?
Well, absolutely right. The attrition in India's financial services space, or the banking space, is nearly double that of the global average and far higher than any of the other large countries like the US, Japan and Germany. And this after we've seen the rate slightly dipping in the most recent data that is available, so much so that some of the large private banks are regularly seeing attrition rates of close to 50% or so. And this is mainly as far as the junior level positions are concerned. This is, remember, very different from what we've seen with respect to senior roles or senior positions, where banker pay has risen dramatically in India as more and more people, get banked. However, as far as the younger staff is concerned, there are reports regularly that as more people open their bank accounts and more people diversify their portfolios in different ways, there is a tremendous competition, very fierce competition that is being seen in traditional banks and modern fintech companies, shadow lenders, who are all eyeing the same piece of the pie, which essentially is leading to very stiff and high competition between various financial institutions, and that is something that is driving the very young staff to the brink. In fact, that's caught the attention of the regulator as well. In fact, the RBI Governor Shaktikanta Das last October had said that the central bank is also watching the attrition levels in the banking sector very closely and will put together a team to address the issue.
All right, Ruchi Bhatia there, our South Asia economy editor. Let's take a quick look at some of the things that are moving in the markets at the moment. We've got a few stocks performing pretty well today. Krafton shares jumping 11%. This is after Citi raised their price target. The game developer beating second quarter operating profit by a big margin. All right, that's it from Bloomberg Markets Asia. Horizons Middle East and Africa up next. This is Bloomberg.